when there's blood in the streets. Lift up, check under the carpet. Many try but few become master of the market.
Well, Peter Cooper, thanks very much for coming on Masters of the Market, the inaugural video version of Masters of the Market. But I know how busy you are, so incredibly grateful that you've taken the time to come on for a chat.
Thank you, Chris. Pleasure to be here.
Now, I thought we'd just start by going back to when you were a public servant with the New South Wales State Super Board. What was a Peter Cooper in his 20s thinking about? What were your hopes for your investing career, and what was your mindset like back then?
It was a bit all over the place, Chris. I joined the public sector back in 1987 at a late age of 27, and sort of in my early 20s was ducking and diving around, multitasking, the original millennial, some people would say. And so I had actually a choice of, when I came back from overseas, travelling around, backpacking as people used to do back in those days, I had a kind of a choice of two jobs. One was to go into a corporate, business analysis role on $27,000 a year, or take a public sector position on $17,000 a year. And I chose heart over head, if you like, in terms of the monetary, and went for the public sector job because it was in a investment department. Back then, State Super Board was the New South Wales Government Employees Superannuation Fund and was the largest pension fund in the country at the time. And it was back in the days of no computers, typing pools, and I, as an assistant analyst, effectively wrote research that gathered dust on a library sort of in a compactus. And so I had a really incredible time there, and I can talk later on about some of the insights and learnings that have sort of transcended and transmitted into Cooper Investors today. But it really gave me, I guess, a safe harbour to do lots of research and lots of reading. Took a lot of opportunity in sort of public sector hours to explore the world of investments, something I didn't actually really know a lot about in terms of the professional end of town. And just sort of developed a whole bunch of thoughts and insights and principles into investing. But one of the great things about the public sector was really this kind of pristine, quiet atmosphere. Some would say backward and not very performance orientated, but there was an incredibly smart group of people there. And it was, what I kind of learned, I've actually made money out of this experience in later careers, that never kind of disrespect the public service, because there's lots of incredible people inside there. Perhaps the bottom line's not the one that you and I are used to, but there's some really deep thinkers, and it was a place where I could, I guess, mature and go deep. And I really love and this is the bit that we've transported in the Cooper Investors, I really love the commitment to long-term investing. So doing the work, allocating the capital and waiting, and not kind of being, back in those days, there wasn't a lot of measurements, there wasn't a lot of stress or anxiety about monthly or yearly performance. And so we've tried to build that into the culture at CI for different reasons than perhaps for the reasons in the public sector.
So you speak about having some time to read widely in that phase of your career. What sort of things were you reading, and who were your influences at the time that you were learning a lot of?
In terms of influences, it was very much books. And there were a number of people inside of State Super who I learned from, but in terms of the great kind of investing principles, it was very much through books and observation of other people. One of the first books that I read was the George Soros book, Alchemy of Finance. Now, I'm not a kind of a top-down sort of guy, but he talked a lot about reflexivity and the relationship between kind of asset, inflation, collateral, and the virtuous circle, if you like, followed by the vicious cycle. And so it was a really key kind of insight that I actually saw in the property boom and bust of the early 1990s. And so that general concept has been very, very significant. We talk a bit about some of the cycle aspects that we deal with in our investment philosophy. But the really, really big influence, and I went crazy on this, is just reading all the Buffett letters, going all the way back to the original partnerships when he was a kind of young man. And I eventually decided to write Warren and Charlie Munger a letter in search of a job. And
did you rock up on Charlie's doorstep? Is there any truth to that story?
There is, and as a result of not getting a reply, I actually rang the office in Los Angeles got through to the secretary of Charlie Munger. And
so what age were you when you were doing this?
I was about 29, maybe hitting 30, and so back in those days, they were pretty popular, but certainly not the level today. And anyway, she was kind of passed on the message to Charlie, and the message came back, look, there's no jobs here, but happy to do breakfast at the Californian Club in Los Angeles. And so I'm a public sector, right? Backwater, nobody. And so I rock up in Los Angeles to the Californian Club, and it was just after they had made that significant acquisition of Wells Fargo's stock. Wells Fargo was sort of in the drink, and so I had this incredible 1 and a half hour breakfast.
It's a huge get, isn't it? I mean, you look at the auction for the Buffett dinner now; it's about $5 million, isn't it?
100%, and so that was just and I was completely out of my depth in the conversation in some respects, but it was just such an incredible, I guess, experience, and to actually be in the presence of somebody like Charles Munger. And I remember, one of the opening bat comments, he asked me, what do you do, Peter, type of thing. And, then he says, and I actually almost prefer Charles Munger in terms of his directness and distillation of wisdom into short sentences. And he says, we're just in completely different businesses, you and I. And then we went from there. And what he meant by that was, the investment management industry, if you like, is open-ended and marketing, and they were effectively, as he described it, kind of a closed-end private equity organisation, investing in real assets, real businesses, not promoting performance and open-ended issues. And so that was that statement has haunted me basically all my life, because really tried to be true to label, true to principles as an investor, and dancing that sort of fine line between that and constructing portfolios for other people, and all the mandate requirements, the legal requirements, the performance pressures and so forth to running kind of money for people who can sack you tomorrow. It has its sort of psychology around it, and he made a very big point about that as being one of their great advantages, that they kind of got this closed-end mentality. The other, just to finish on the Munger, I sort of went off the whole, went to a couple of the AGMs. I'm actually going to go there this year, taking my kids along to give them a kind of final immersion. I don't think there's, lots left. And so I've kind of done the full circle. I went, for a decade or more, just, couldn't kind of stand any more Warren stories. And but look, as popular as they are, that you just cannot get better in terms of the wisdom that's so articulately laid out and thought about and communicated. I just think you go to their website, I keep on, we don't really have marketing people, but it's just this ridiculously simple website, and it's got the most incredible wisdom for free embedded in the 30 odd years of newsletters. So the other super, and probably the most combination of these three, but the Peter Lynch story had just such a huge impact, and probably reflects, so much of my own, I guess, beliefs and way of investing. This idea of getting out there, getting around the traps. We kind of proudly say we do 1,000 one-on-one visits with companies a year in a very methodical way, and it really originated back to that, I guess, Peter Lynch methodology of open your eyes, get out and actually see what's happening at customer level and stakeholdership level. So he also had a simplicity, for my brain, was just ideal. It was actually pretty straightforward, and I think one of the complexities, or one of the issues in investment, there's so much complexity, there's so much information, and just being discerning on how to filter out the noise and focus in on the signal is really the trick in the trade, I think, even as a long-term investor. And so Peter Lynch and his sort of colleague in the UK, there's a kind of an equivalent called Anthony Bolton. And so he's had a sort of version of a Peter Lynch, were very, very influential on my investment thinking, and kind of, so there's, lots of versions and Masters of the Universe type books that I've read over the years, but they would be the main ones.
And you speak about observation, not prediction, at Cooper Investors. Does that speak to where you sit in the risk profile? I look at sort of venture capital investing, where it really is predicting what the world's going to look like in 5, 10, 15 years, and you have mostly blow-ups and a couple of spectacular successes. Yep. Is that the right way to interpret that statement, or how do you feel?
No, it's much more philosophical than that, and I believe the concept can be applied to anything. Picking fund managers, picking companies. It's actually a philosophy of research. One could say it's got elements of the call it the scientific method, if you like, around evidence and distilling down into observable facts from hypotheses and predictions and models. And I think it is true to say we're not down at the VC end of the risk sort of profile. I was very interested listening to Peter Thiel talk about his. You're familiar with Peter Thiel, the
Facebook original 10% owner and
PayPal, and he sort of he didn't talk about observation, not prediction, but he talked very much about there's this sort of probabilistic aspect to venture capital. 20% sort of make all the money and 80% you lose money on. But he kind of approached it like every one of those stocks that he's investing in, he believes is going to be a success story, and the level of due diligence and kind of his methodology is very reliant on high hit rates. Now, how that works out in his portfolios, I can't talk to, but it was interesting how focused he was on not sort of just relying upon portfolio and the odd winner to make up for all the losses, which is sort of how we think about our investments. And I can talk a little bit about our own hit rates in a moment. The observation, not prediction, really goes to the heart of setting up some hypotheses and looking at why these hypotheses may or may not work, and really getting into, and this is the key nuance, I think, really getting into the incentives and behaviours that sit behind observable facts. Because I guess anyone can sort of say, well, that's a fact and that's not. But there's a sort of very strong belief in the philosophy of investing that behind every numeric, and so people often talk about things like you can be creative with accounting, but cash is cash. Well, I actually don't believe that. We can talk about that because you can manufacture cash as well, and companies do all the time. But we really like to get behind numbers in annual reports and balance sheets and really understand the behaviour. What are the motivations? What are the contexts? What are the historical norms that sit behind these numbers? And so that's where we're really looking into the second level of interpretation of the facts and these hypotheses that we have on investing in companies.
So it's a sort of a qualitative approach initially. That's your main focus when you come to analyse a company.
We have a deep belief that qualitative investing is where we can add value.
Yeah.
And we do a lot of quantitative analytics, but the value add and the value proposition is very much in the pointy end of that statement, that qualitative first investing. It's kind of where we're getting into the probabilities, the levels of conviction around management teams, getting into anyone can look at a track record of a management team and kind of done lots of attribution analytics on this, and we suffer a little bit from this ourselves, where great track record, front page of the Financial Review as a guru, and only to find that it's a slippery slope to the other side. And so our kind of methodology is always sort of asking the question, what's the track record like, and can they keep it going? And like in teams, Chris, it's very much philosophically believe in the end everything's cyclical. We're talking about secular and cyclical, but life, biology, the planet, the universe, and investing, there's this ebb and flow aspect. And so when we look at these attributes of investing, like management teams and industries and business models, it's always with an eye of, well, can they keep it going? And so we use this term pattern recognition. And so when we're looking at management teams, it's why have they been successful? What category of management? We like to have these genres for different aspects. We've got something called subsets of value. We have 3 categories of management teams: family-linked, founder-led companies, owner-operator companies, where there's very, very strong alignment with kind of shareholder concepts. Something like a Macquarie Bank would be a good local example of that. And then what we call specialist management teams. These are kind of the turnaround, professional hired guns in a sense, taking companies private or public to private, IPOs and so forth, where the teams are, not necessarily embedded forever in the cultures of those companies, but they can. And sometimes external management, whilst not our preferred sort of management structure, can actually add a lot of value. So we kind of categorise these.
And do you have a bias towards the family-owned and run style model?
What we're looking for is proprietorship. The people who really, really believe in the business, in the customers, in the employees, and the community effects generally. And there's a deep belief. And so that's why I say, certainly the owner-operator cultures and the family founder companies is where you've got, people talk about skin in the game, but you get, I think the real bit is the soul in the game. It's this emotional connection and deep knowledge around the nuances of industry, all the people, how an industry works, takes years and decades to build up. And it's something very much noticed this, these new management change-outs come into, particularly in, large cap land, and, it's just so disappointing because they talk a big game, they've had the McKinsey, they bring the consultants in, and, under the heading of pattern recognition, we've seen this movie before, and, we've got one in the press at the moment with Mike Cain, who we actually quite liked in the early stages, and this pattern recognition added a lot of value because he was got a deep industry knowledge, but suffering from the sort of hubris disease.
And so how do those managers behave differently if they are proprietors versus institutional-owned businesses in broad generalisations?
Look, I think it is general because we can't tarnish all the companies with a generalisation. There are good and bad founders.
Just got all the consultants offside that are watching.
One example is the way they think about risk, and it's a perverse nature. And I'm going to pick on BHP, and this is BHP of old. We actually think the new chairman and the current new appointed CEO are actually doing a fantastic job, and we actually own BHP, so this is of yesteryear's story. And so top of the 150-year high commodity prices, right? Those guys could not spend, and Rio Tinto as well, they could not spend enough money, and anyone could look at a chart of all their exposures in commodities. And so they had and I wasn't in the boardroom, but they had a bunch of happy clappers there, surrounded by consultants justifying why this time was different. And so, when it all blew up, at the bottom of the commodity cycle, they spent zero. You could have owned the whole industry. And so they had this sort of pro-cyclical approach to risk. When times are good, they feel, we can invest and continue on, and it all continues on. When the opportunities are there, they're nowhere to be seen. Now, the proprietorial companies are much meaner and conservative the longer that cycle goes on, because it's their money and their family, and they know how hard it is to make and how easy, the good ones, how easy it is to lose. But they're very aggressive when the opportunities come onto the scene for various reasons. So it's kind of an opposite reflection upon risk and how you deal with risk and opportunity. The other thing that's very noticeable is continuity. A lot of these professional managers, they just keep on moving up to bigger jobs, and they kind of leave the mess behind for others to clean up. Whereas, where there's a lot of investment and soul and emotion in the game, they kind of fix the problem up and really face up to the problems that they encounter, work through it, and they have the skill sets. They know where the bodies are, so to speak, and they know the nuances of the industry around how to fix up the problems. So that would be a couple of examples.
So I've read before you say you're not overly interested in macro type political events. What level of interest do you take in, say, something like the US elections coming up and the likelihood or possibility that someone like a Bernie Sanders could get in? Does that start to enter some of your economic models around, if the helicopter money comes in, or do you just ignore that and stick to stock-specific issues?
Look, we're definitely interested in environment, and to the extent that macro, has big impacts upon environment, we're interested. But I guess the filter that we look at these things through is, long-term lens and observation, not prediction. And so, where we can have, I guess, insights into how is this going to affect industry, and how are we going to deal with all the complexities of top-down, we often say we don't know, okay? And so not that we're not interested, is we just don't know. Now, on Bernie Sanders, I've taken a bit of an interest in the US elections. My partner's American. Her cousin's was a nominee to the Supreme Court, and so the family's embedded, in kind of the political conversation. So I had the opportunity over Christmas to get into all these sort of nuances, and watched a few of the Democratic candidates do their debates and so forth. And so, look, Bernie's got his issues, and he's tagged as a socialist, and I'm probably not a fan. Having said that, he's got some interesting insights into the healthcare system in America, and he's the only candidate in the short debate that I watched who actually articulated a really, really key point, and that is America spends twice as much as Australia and Western Europe per person on healthcare. And for the bottom half of Americans, it's the worst healthcare system in the world. For probably the top 20%, it's the best healthcare system in the world. And so, he kind of has a really interesting way of articulating the landscape. But I'll leave it at that, because we can't really add that much value around sort of extrapolating his policies, and helicopter money is not sort of the exclusivity of the Democrats or the Labor Party here. The Trumpster is...
Will it be fiscal stimulus with Trump, and it'll be helicopter money with the Democrats potentially?
So the general politics drops quickly down into industry, impacts of government policies on industries. Regions, very interesting, looking at kind of demographics and, those southern parts of the US. And one thing that has had a, very big influence on us through a slightly different lens is just this kind of confrontation that globalization is involved in, whether, Western Europe here or the US. And I think in terms of my career, I guess you could say I've been a massive beneficiary and a tailwind. And I think one of the really big themes, and it's going to get really messy, so I don't think it's easy to come to conclusions from an investment perspective, but one thing I definitely believe in is this kind of return to some sort of localisation and representation, because so much of the politics is being driven by disenfranchised people, whether it's the inequality statistic that people totally generalise on, and it's probably an issue, but it needs to play out, I guess, through social politics and different cultural lenses. But you can see that alive and well. That drops into kind of policies. Taxation is another thematic. I think whilst America has dropped corporate taxes, other taxes are going through the roof, and so there's a lot of gross and net conversation to be had about who's a beneficiary and who's going to be a loser out of some of these policy changes. So we're definitely interested in those type of, I guess, conversations around industries, migration of populations. You've in North America and Australia for that matter, these sort of coastal areas, sunbelt areas, lower taxation areas will be kind of beneficiaries of population and industry, and you can sort of see, particularly one of the great things about US, the industry is just moving around all the time. There's kind of little Silicon Valleys popping up, around recently in Miami, and Florida was sort of a retirement village, 20 years ago. Well, it's a very vibrant economy today. There's lots of different aspects to that economy, and I think there's 30 million people in Florida. So these are big countries in their own right, or equivalent to countries in their own right.
So you've got a reduction in globalisation, which I assume would be somewhat inflationary. Then you've got ageing demographic and technological change, which has proven to be deflationary. What wins in that arm wrestle?
I think, there's this, first of all, community-based, and getting back to, our conversation about management teams, so delivering real value to local communities. And so, in the local examples would be companies like Lifestyle Communities, for example. That's, hitting two targets there. One, they've just got this incredible referral rate because they actually treat people who go into their villages in a very, very special way, and you see that through the sales rate, the waiting lists, the referral rates, and so I think they're getting 60% of their sales now from referrals. So that's a kind of a statistic to zero in on. In addition to that, you've got this wave of, and they're in they like to call it, resort style living. Now, unfortunately, I sort of qualify as a customer, and so they've kind of broadened the category even further from retirement. But they've really, really just hit the bullseye in terms of identifying a demographic product, and I think whether it's sort of nappy producers in Japan or retirement villages, or technology, by the way, hitting into this. And so, with lots of these kind of mega themes, there's level 1, level 2, level 3, and I think the technology side of things in so many ways, can develop new business models, for young people, old people. We're seeing a lot of, we'd call them productivity type plays in terms of verticals, B2B, so the big capitalisations are in the retail or B2C models, the Facebooks and the Tencents of the world. Well, there is many decades of opportunity and growth to remodel the economy in the B2B space. So platforms and verticals that might be niche. We're invested in a company called Constellation Systems, which is basically a collection of verticals dealing with government efficiency, back offices of companies. So I think a confluence of both demographics and globalization, the productivity stats are a really interesting one, sort of run out of steam, and this is a bit of an irony, with all the talk about, technology and AI and data analytics, the actual stats on employment and productivity don't reflect, the exuberance in the investing community around, how things are going to change so much. And so that's a kind of interesting macro phenomena.
But you've worked for a long period of time in the real world, if you like. I speak to some people who are CEOs. They said in the early 90s, if they needed some legal documents done, everyone would go to a meeting, everyone would be in the same room, they'd have a discussion, and the document would be executed within an hour or two. Now an email gets sent off, it gets marked up by one person who sends it off to another person who marks it up again. And even though there's this perception that things are much more efficient through technology, their view was it was actually more efficient, in the early 90s when you had a secretary typing up letters and all this technology wasn't around. Do you feel there's any truth to that?
Oh, absolutely. And I go back to, seriously, used to write out by hand research reports, go off to a typing pool, come back 2 days later. So what I think's happened, there's a kind of an inefficiency, it's almost a neuroscience point. Just because you can see information doesn't make you more informed if there's just more of it, more distraction, and everyone's got the same information bombardment at the same time. There's a kind of a backstory around the inefficiencies of, technological access to information. But I think, look, there are so many, but now I kind of type up my own reports type of thing. So, there's kind of nuances around this, and there's lots of industries that won't be here tomorrow, and that's been the case time immemorial anyway. So, where are we going with all this? I think there's going to be change. There's clearly change in the workplace. But there are, having said that, we're looking for space up at the other end of Collins Street. There isn't any. It's just fully booked out. Occupancy, vacancies at the world record lows. One of the main reasons is there's a hub effect up that end of Collins Street between bankers, investment managers, government consultants and so forth, where there's a real face-to-face network effect. And I think you see that in in big cities around the world. The kind of idea of a mega city has not gone away. In fact, it's accelerating where you get infrastructure. And I often live at Middle Park. You've got access to incredible sporting facilities, a magnificent botanical garden, catch the tram into work. Well, the outer suburbs and certainly regional towns don't have that level. So there's a lot of paradoxes, I think, around how it's going to play out with technology and what people want. And just getting to the investment themes here, the three mega themes that we see in our journeys. First of all, government. It's just huge and getting bigger in terms of regulation, taxation, influence in implicit and explicit over industry. Doesn't matter where you go, government is going to be a really big factor.
And is this Australia or this is global?
Well, this is worldwide phenomena, but it's very applicable to Australia. So getting one's head around, well, how does that impact your kind of decision making around the worth of an asset? I think is worth really sort of spending a lot of time on. The second one is what I'd call the new economy, which is what we've been talking about. There's going to be new business models. We're not so much just focusing on new tech or VC, but we're very interested in how does technology, and this is the kind of the investment theme for people investing in existing companies, how do they actually use that technology to be better companies, to connect better with customers and suppliers and so forth. And so local exam, we've got just loaded full of those. They're, one level they're kind of old industrial companies, both globally and domestically, but they're really using technology in a smart way. And I think Woolworths would be a call out. They've really gone hard. CBA Bank really hard on getting to the forefront of where they need to be technologically. The benefit of that is they've got incredible reach already, and so they've basically got the wallet already, which is the hard thing to get, and now they're all about expanding the share of that wallet using new ways of doing business. And so finding these new business models, like a Xero, for example, what we're interested is in kind of incumbency. We're not looking for the new guy to knock off the incumbents. We're looking for those incumbents who've got the wherewithal to reinvest and really make themselves even better incumbents than what they are. And we talk a lot about this idea of economies of scope. And so there's economies of scale, but very underappreciated the economies of scope, complementary products that can be, I guess, dropped in on a platform business or a franchise and so forth.
Who's an example of that that's doing it well in Australia?
Certainly Xero. I mean, they know more about National Australia Bank. So National Australia Bank, biggest SME banker here, I'd argue that Xero know more about NAB's customers than NAB know, because they're seeing the behaviour, and it's that's where the AI machine, the cycle of payments. So they've got just so much kind of rich data on SMEs down to postcodes and locations. So that's really powerful. In the global scene of things, somebody like a Colliers, which is you probably think of as a real estate flogger, but they're a really powerful platform business with a lot of IP around facilities management and asset management, and they really kind of take their internal information. Macquarie Bank is just probably the best example. They're just masters of reinventing and taking, the original infrastructure business came out of a tax minimisation or optimisation business back in the 80s, and they just take IP and basically find an adjacency, and off they go. And the third area, and I think this has got so many different angles, it is this idea of community and connection, and you just see it in young people, you see it in older people, but you just see it in employees, really wanting to belong to a tribe. Okay, and I know it's a little bit anthropological, but I really believe in it, and you see it in these companies. These great leaders really enthuse ownership and belonging, whether it's an employee or a customer, loyalty. And I just think, in this sort of globalization thing, this idea of being genuine and authentic. Now you've got to make money, and corporations are there to, serve customers and shareholders. So, companies need to work out the balance and all of that stuff. But the winners will be those with, real value propositions that connect to these, community concerns and the need to belong.
Do you think that's almost a void that's being left from religion, particularly in countries like Australia where religion's not nearly as prevalent or as popular as it was generations ago?
Yeah, well, that could take us on a very interesting...
Do you think it's being fulfilled by some...
Yeah.
I mean, you look at Elon Musk, people view him as a god, some people.
Yeah.
Almost like...
the recutting of society and how that looks. The 1950s model's not coming back.
Yeah.
I don't believe, but the missing bit is this kind of genuineness. I think people kind of... You see it in whether it's right or not, or whether it's the right candidate. You see it in politics. You see it in social media. This kind of tribalism that runs through decision making. And I think this, and it sits within our very in the middle of our, I guess, values and cultural philosophy on organisation for ourselves. This idea of authenticity, being kind of true to your word. My word, it's a bit of a hackneyed thing, my word is my bond, is kind of been adapted by business and, society, where, people kind of tell lies and they keep their job. I'm not quite sure why that came about. Back in the old days, it was a jewel out the back. I do think there's a kind of an aspect of old values that will recycle back in a new cut society.
And you've spoken publicly quite a bit about meditation, and that's something you do daily. And you mentioned State Super Board, how one of the pieces of that culture that was so valuable to you was having some time to do some reading and perhaps less pressure than you could have had elsewhere in the corporate world. How do you weigh up those beliefs and values with also valuing hyper-competent employees that are working hard and driving hard to create value for your investors?
I guess my interest in meditation and yoga and contemplative philosophy would have originated out of sort of personal anxiety and stress. And
when did you start doing that?
I had I remember when I first moved down to Melbourne, probably 1994, being super stressed out and getting up at 5:30 in the morning. I read some little book on meditation, going to my room and kind of meditating for 20 minutes and running off to work. And then, after 3 weeks, and I was just kind of in my own little bubble, if you like. And, after 3 weeks, I just kind of dropped the ball on that and moved on to the next thing. So that was my first introduction. It wasn't sort of really until probably about 7 years ago I was reintroduced and got some proper instruction, and I have a very supportive partner who's really helped me in the discipline of yoga and meditation. And quick funny story, just up at the church opposite 101 Collins Street, I was in level 29, looking at the monthly numbers. They were absolute shit and really stressed out. And so in the church opposite, on the corner of Russell and Collins Street, still there today, I used to go and sit in the church and kind of just, hold my head in my hands. And then I noticed underneath the church of Collins Street, there's a little meditation centre called the menagerie it's called. And so it's this little cave, very dark lighting, a little rock with some water flowing over it and chairs around the outside, okay? And so this became a regular place I'd just go to just to kind of have some breathing time. But the funny bit of the story, which is when I stopped going there, is I'd be there in my pinstripe suit, be sitting there, meditating, really dark light, and then other people would start walking in and I'd start to recognise other people. So it was very embarrassing. So, I kind of used meditation initially as a way of dealing with my anxiety and stress and so forth. But the whole purpose for me around these contemplative practices is really getting self-awareness, and really thought a lot about this in terms of the investment process, because we do all this training and read books on Warren Buffett, etc. But what I can say is that unless people actually get to know who they are, and it's the great misnomer, or it sounds a bit funny, but people actually don't know who they are. And this is where it sort of begins. You de-stress, you start to actually feel your own, I guess, purpose in life, figure out your ranking of values and goals and aspirations, and from that place you can then sort of move forward and start filtering, some of the things that you want to get involved in, including investment. The other aspect of, and this is, I've kind of linked all of these ideas back to investing, and I can say these, contemplative or spiritual practices, some people term them, are just a gold mine if you actually apply them to life, including investing. The other attribute that really tried to embed in CI is this idea of discipline, and not in an authoritarian sense, but in self-discipline. And so working out, what are those habits that you have to kind of train at and build, in the pursuit of finding gold on the street, removing all the distractions, sticking to one's knitting is really, really difficult. And that's why in investments, the statistics are terrible for active managers. That's a long distance horse race, and most fall at the 10-mile mark sort of thing. So I think these practices, and there's lots of different aspects to them, but they really start to build internal, confidence, internal knowledge that then can be applied to investing.
Now, I'd just like to finish off with 3 final questions. What was your first ever investment?
It was a real estate investment in a penthouse in Brisbane in the early 1990s, and interest rates went from 15 to 21%, and the value of this beautiful, very prestigious suburb called Toowong went down at least, or went down. I lost about 30-40% of my money, leveraged, and that was pretty ugly.
And what advice, investment or otherwise, would you give to your 18-year-old self?
Start early, read extensively, and get into this contemplative mindset of really understanding yourself before you adopt investment philosophy, because I really, really believe this, that sort of you're matching, long-term, short-term, asset classes. What is it that you actually really like? Because to keep it going in investment land, it's a long-term thing, and I think unless you kind of marry your own sense of purpose up with those investment philosophies, you won't actually make it. So start early and get into the idea of understand what self-discipline actually means in terms of that investment philosophy.
And what's the most common mistake you see retail investors make?
They make, I can explain this through, if you look at 20-year studies on investment managers, and then you take the best quartile, this is a US study, the best quartile of those fund managers, and then ask, how did the average investor do? What you find is the average investor actually underperforms the market because they put the money in after or at the top of the cycle, and then and we saw this in the GFC, then they take the money out. And what that shows is they're not really clear on their strategy. Because the strategy should incorporate, in my career, every 15 years we get the 40% dip. So the strategy needs to incorporate something like that. And even perhaps the 100-year 80% down. So you can actually really stick, because the best opportunities really come in those down dips. If you're not positioned to survive those and invest in those, you're going to do poorly.
Peter Cooper, it's been absolutely brilliant. Thanks again for coming on Masters of the Market.
Thanks, Chris. Really appreciate it. Thanks, buddy.
To buy when there's blood in the streets, lift up, check under the carpet. Many try but few become master of the market.